Question 1. Risk assessment procedures indicate that a client, who has been with the firm for several years and has a generally good standing, has recently engaged in a series of complex, high-value transactions that appear unusual given their stated business activities and lack a clear economic or lawful purpose. The client has been evasive when questioned about the specifics of these transactions. What is the most appropriate immediate course of action for the firm? Option A. Conduct a thorough internal investigation and escalate the matter to the firm's Money Laundering Reporting Officer, MLRO, or Compliance Department. Option B. Immediately report the suspicious activity to the relevant Financial Intelligence Unit. Option C. Take no action as the client has a long-standing positive relationship with the firm. Option D. Advise the client that their transactions are being scrutinized and request further documentation. The correct answer is B. Immediately report the suspicious activity to the relevant Financial Intelligence Unit. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between client confidentiality and the regulatory obligation to report suspicious activities. The firm is entrusted with sensitive client information, creating a duty of care and loyalty. However, the regulatory framework imposes a duty to act in the public interest by preventing financial crime. Navigating this requires a nuanced understanding of when and how to escalate concerns without breaching client trust unnecessarily or prematurely. The challenge lies in identifying the threshold for suspicion that triggers a mandatory reporting obligation, balancing the need for thorough investigation with the urgency of potential illicit activity. Correct approach analysis. The correct approach involves a systematic internal escalation process, adhering strictly to the firm's established anti-money laundering (AML) and suspicious activity reporting (SAR) policies. This aligns with the Vinci hiring assessment test's likely emphasis on regulatory compliance and internal controls. By reporting the suspicion internally to the designated compliance officer, or MLRO, Money Laundering Reporting Officer, the firm ensures that the matter is handled by individuals trained and authorized to assess such risks. This process allows for a confidential, thorough investigation within the firm, gathering further evidence if necessary, and making an informed decision on whether a formal SAR needs to be filed with the relevant authorities. This approach upholds both client confidentiality by not making premature external disclosures and regulatory obligations by initiating the reporting process when suspicion is reasonably formed. It demonstrates a commitment to the principles of integrity and due diligence expected of financial professionals. Incorrect approaches analysis. Directly reporting the suspicion to the authorities without internal consultation or investigation is a significant regulatory and ethical failure. This premature external disclosure could breach client confidentiality without sufficient grounds, potentially damaging the client relationship and the firm's reputation. It bypasses the firm's internal controls designed to prevent frivolous or unsubstantiated reports, which constrain regulatory resources. Furthermore, it demonstrates a lack of professional judgment and adherence to internal procedures. Ignoring the suspicion and taking no action is a grave regulatory and ethical failure. This directly contravenes the firm's AML obligations and the broader regulatory framework designed to combat financial crime. It exposes the firm to significant penalties, reputational damage, and potential complicity in illicit activities. It signifies a disregard for professional responsibilities and a failure to uphold the integrity of the financial system. Discussing the suspicion with the client directly before any internal reporting or investigation is also a serious ethical and regulatory breach. This action could tip off the client, allowing them to conceal or destroy evidence, thereby obstructing a potential investigation by the authorities. It also violates the principle of confidentiality regarding internal suspicions and the firm's reporting obligations. This demonstrates a profound lack of understanding of the purpose and procedures of AML regulations. Professional reasoning. Professionals facing such situations should first consult their firm's internal policies and procedures regarding suspicious activity reporting. This framework typically outlines the steps for identifying, assessing, and reporting suspicions. The decision-making process should involve a clear understanding of the relevant regulatory definitions of suspicion and the threshold for reporting. If suspicion is reasonably formed, the immediate next step is internal escalation to the designated compliance function. This ensures that the firm can conduct a proper assessment and, if necessary, make a timely and appropriate report to the authorities, thereby fulfilling its regulatory duties while managing client relationships responsibly. Question 2. Compliance review shows that a client has expressed a strong desire to achieve aggressive growth in their portfolio within a short time frame, citing a specific, high-return target. However, subsequent risk profiling indicates a low tolerance for volatility and a limited capacity for loss. The client also appears to have a limited understanding of complex investment products. How should the financial advisor proceed? Option A. Re-engage with the client to thoroughly discuss the apparent conflict between their stated objectives and their risk profile, explaining the potential consequences of pursuing aggressive growth given their low risk tolerance and limited understanding, and then propose a revised, more conservative strategy that aligns with their capacity and provides realistic growth expectations. Option B. Recommend a highly complex, high-risk investment product that, on paper, could potentially meet their aggressive growth target without delving deeply into the product's intricacies with the client. Option C. Inform the client that their objectives are incompatible with their risk tolerance and suggest they seek advice elsewhere. Option D. Proceed with recommending investment products that aim for aggressive growth, as this is what the client has explicitly requested, assuming they understand the inherent risks. Correct answer is A. Re-engage with the client to thoroughly discuss the apparent conflict between their stated objectives and their risk profile, explaining the potential consequences of pursuing aggressive growth given their low risk tolerance and limited understanding, and then propose a revised, more conservative strategy that aligns with their capacity and provides realistic growth expectations. Explanation. Scenario analysis. This scenario presents a common challenge in financial services where a client's stated investment objectives appear to conflict with their risk tolerance and financial capacity. The professional must navigate this discrepancy to ensure the client's best interests are met, adhering to regulatory obligations and ethical principles. The challenge lies in balancing the client's desires with a responsible and compliant recommendation, avoiding misrepresentation or unsuitable advice. Correct approach analysis. The correct approach involves a thorough reevaluation of the client's situation, seeking clarification on their objectives, and explaining the implications of their risk tolerance on achieving those objectives. This aligns with the regulatory framework's emphasis on suitability and client understanding. Specifically, it upholds the duty to act in the client's best interests by ensuring that any proposed investment strategy is both appropriate for their circumstances and that they fully comprehend the associated risks and potential outcomes. This proactive engagement and clear communication are paramount to fulfilling regulatory requirements and maintaining client trust. Incorrect approaches analysis. One incorrect approach involves proceeding with the client's initial, potentially unsuitable, request without further investigation. This would constitute a failure to conduct adequate due diligence and a breach of the suitability obligations, as it prioritizes the client's stated wish over their actual capacity and best interests. It risks exposing the client to undue risk and could lead to regulatory sanctions for providing inappropriate advice. Another incorrect approach is to dismiss the client's stated objectives outright and unilaterally impose a different strategy. While the professional may identify a more suitable path, doing so without engaging the client in a discussion about the rationale and seeking their agreement undermines client autonomy and the principle of informed consent. This could be seen as paternalistic and may not fully address the client's underlying motivations, potentially leading to dissatisfaction and a breakdown in the professional relationship. A third incorrect approach is to present a highly complex product that superficially appears to meet the stated objectives, but carries hidden risks or costs that are not adequately disclosed. This would be a clear violation of transparency and disclosure requirements, as well as the suitability rules. The professional has a duty to ensure the client understands all material aspects of any recommendation, not just those that align with their initial stated desires. Professional reasoning. Professionals should adopt a structured decision-making process that begins with a comprehensive understanding of the client's profile, including their objectives, risk tolerance, financial situation, and knowledge. When discrepancies arise, the next step is to engage in open and honest dialogue with the client to clarify their intentions and educate them on the implications of their choices. Recommendations should then be tailored to the client's best interests, supported by clear explanations and appropriate disclosures, ensuring compliance with all relevant regulations and ethical standards. Question 3. Strategic planning requires a financial advisor to assess a client's stated desire for aggressive growth investments, which the client believes will help them achieve early retirement. However, the advisor's initial review indicates the client has a low risk tolerance and limited understanding of complex financial instruments. What is the most appropriate course of action for the advisor? Option A. Conduct a detailed risk tolerance assessment and discuss investment strategies that align with both the client's stated goals and their assessed risk profile, explaining the trade-offs involved. Option B. Advise the client that their goal of early retirement is unrealistic given their risk tolerance and suggest a more conservative, long-term savings plan. Option C. Immediately proceed with the client's requested aggressive growth investments to demonstrate responsiveness to their stated goals. Option D. Present a portfolio heavily weighted towards high-return, high-risk products, emphasizing the potential for rapid wealth accumulation. The correct answer is A. Conduct a detailed risk tolerance assessment and discuss investment strategies that align with both the client's stated goals and their assessed risk profile, explaining the trade-offs involved. Explanation. Scenario analysis. This scenario presents a common challenge in financial advisory, where a client's stated investment goals may not align with their risk tolerance or the prevailing market conditions. The professional must navigate the client's subjective desires against objective financial realities and regulatory obligations. The challenge lies in providing advice that is both commercially viable for the firm and, more importantly, in the client's best interests, adhering strictly to the Vinci hiring assessment test's regulatory framework, which emphasizes client protection and suitability. Correct approach analysis. The correct approach demonstrates a commitment to understanding the client holistically. It involves a thorough assessment of their financial situation, risk appetite, and investment objectives, followed by a clear explanation of how these factors influence suitable investment strategies. This aligns with the core principles of client-centric advice mandated by regulatory bodies, ensuring that recommendations are suitable and in the client's best interest. It prioritizes a fiduciary duty to the client, which is paramount in financial advisory. Incorrect approaches analysis. One incorrect approach involves immediately agreeing to the client's request without further investigation. This fails to meet the regulatory requirement for suitability assessments. It risks recommending investments that are inappropriate for the client's risk profile or financial capacity, potentially leading to significant losses and regulatory breaches related to mis-selling. Ethically, it prioritizes client satisfaction over client well-being. Another incorrect approach is to dismiss the client's stated goals outright and impose a predetermined strategy. This disregards the client's autonomy and their right to have their objectives considered. It can lead to a breakdown in trust and may violate regulations requiring advisors to act in accordance with the client's expressed wishes, provided they are suitable. It also fails to explore potential solutions that might bridge the gap between the client's desires and realistic outcomes. A third incorrect approach is to focus solely on the potential for high returns without adequately discussing the associated risks. This is a direct contravention of disclosure requirements and the principle of fair representation. Regulators expect advisors to provide a balanced view of investments, highlighting both potential benefits and drawbacks. Failing to do so can lead to regulatory sanctions for misleading the client. Professional reasoning. Professionals should adopt a structured decision-making process that begins with active listening and thorough information gathering. This includes understanding the client's stated goals, but critically, also assessing their financial capacity, risk tolerance, and investment horizon through objective means. Following this, the professional must educate the client on the implications of their goals in the context of their profile and market realities. Recommendations should then be tailored, clearly explaining the rationale and the suitability of each proposed investment, including associated risks and potential returns. Transparency and ongoing communication are key to building trust and ensuring compliance. Question 4. The evaluation methodology shows that a client has requested a specific investment strategy that appears to push the boundaries of current regulatory guidelines. While the strategy is not explicitly prohibited, it carries a significant risk of being deemed non-compliant upon closer regulatory scrutiny. The client is insistent, emphasizing the potential for high returns and expressing frustration with what they perceive as overly cautious advice. How should the professional proceed? Option A. Clearly explain the regulatory risks associated with the proposed strategy, detailing potential negative outcomes of noncompliance, and explore alternative compliance strategies that align with the client's return objectives. Option B. Recommend seeking legal counsel for the client to interpret the regulations, absolving the firm of direct responsibility for the compliance assessment. Option C. Advise the client to proceed with the strategy, highlighting the lack of explicit prohibition and downplaying the potential for regulatory scrutiny to maintain client satisfaction. Option D. Implement the strategy as requested, assuming the client understands and accepts the inherent regulatory risks, and document the client's instruction. The correct answer is A. Clearly explain the regulatory risks associated with the proposed strategy, detailing potential negative outcomes of noncompliance, and explore alternative compliance strategies that align with the client's return objectives. Explanation. Scenario analysis. This scenario presents a professional challenge involving the interpretation and application of regulatory requirements in a client advisory context. The core difficulty lies in balancing the client's stated objectives with the firm's regulatory obligations and ethical duties. A professional must exercise sound judgment to identify potential conflicts and ensure compliance without alienating the client. The pressure to retain business can create a temptation to overlook or downplay regulatory concerns, making ethical vigilance paramount. Correct approach analysis. The correct approach demonstrates best professional practice by prioritizing regulatory compliance and ethical conduct. It involves a proactive and transparent communication strategy with the client. By clearly explaining the regulatory constraints and their implications, the professional upholds their duty to provide accurate and compliant advice. This approach aligns with the principles of integrity and professional competence expected under regulatory frameworks, ensuring that advice given is not only commercially viable for the client, but also legally and ethically sound. It also fosters trust by demonstrating a commitment to responsible advisory practices. Incorrect approaches analysis. An approach that focuses solely on fulfilling the client's immediate request without considering regulatory implications fails to uphold the duty of care and professional competence. This could lead to advice that, while commercially appealing, breaches regulatory rules, exposing both the client and the firm to significant risks, including fines, sanctions, and reputational damage. This constitutes a failure in professional judgment and potentially a breach of conduct rules requiring adherence to applicable laws and regulations. An approach that attempts to find loopholes or interpret regulations in the most favorable, yet potentially misleading, way for the client without full disclosure of the risks is ethically compromised. This can be seen as a form of misrepresentation or a failure to act with integrity. It undermines the spirit of the regulations, which are designed to protect investors and market integrity, and can lead to serious regulatory action. An approach that dismisses the client's concerns about regulatory compliance as secondary to commercial objectives demonstrates a lack of understanding of the fundamental importance of regulation in the financial services industry. This can result in advice that is non-compliant and ultimately detrimental to the client's long-term interests and the firm's reputation. It signifies a failure to act in the client's best interests, as regulatory breaches can have severe financial and legal consequences. Professional reasoning. Professionals should adopt a framework that begins with a thorough understanding of the client's objectives. This understanding must then be rigorously assessed against all applicable regulatory requirements and ethical guidelines. If a conflict arises, the professional's primary responsibility is to communicate these constraints clearly and transparently to the client, explaining the rationale behind the regulations and the potential consequences of noncompliance. The professional should then work collaboratively with the client to explore compliant alternatives that still meet their underlying commercial needs. This process emphasizes proactive risk management, ethical integrity, and client education, ensuring that all advice is both commercially sound and regulatorily compliant. Question 5. Stakeholder feedback indicates a potential pattern of activity by a client that, if confirmed, might fall under mandatory reporting requirements for suspicious transactions. However, the feedback is currently anecdotal and lacks definitive proof. The firm has a strict policy on client confidentiality. What is the most appropriate course of action? Option A. Immediately file a suspicious activity report with the relevant regulatory authority based on the anecdotal feedback to ensure full compliance and avoid any potential penalties. Option B. Inform the client directly about the stakeholder feedback and the potential reporting obligation, seeking their explanation before taking any further action. Option C. Disregard the feedback as it is anecdotal and lacks concrete evidence, to avoid any unnecessary administrative burden and potential disruption to the client relationship. Option D. Conduct a discrete internal review of the client's recent transactions and communications, in line with established compliance procedures, to ascertain if the feedback warrants a formal report, while maintaining client confidentiality throughout the process. The correct answer is D. Conduct a discrete internal review of the client's recent transactions and communications, in line with established compliance procedures, to ascertain if the feedback warrants a formal report, while maintaining client confidentiality throughout the process. Explanation. This scenario presents a professional challenge due to the inherent conflict between client confidentiality and the need to comply with regulatory reporting obligations. The firm is entrusted with sensitive client information, and any disclosure must be carefully considered to avoid breaching trust and violating data protection principles. However, regulatory frameworks often mandate reporting of specific activities or transactions, creating a tension that requires astute judgment. The professional must navigate this by understanding the precise scope of reporting requirements and the exceptions or thresholds that might apply, while also upholding the duty of care to the client. The correct approach represents best professional practice because it prioritizes a thorough understanding of the regulatory landscape and the specific client situation before taking any action. This involves consulting internal compliance policies, seeking clarification from the relevant regulatory body if ambiguity exists, and assessing whether the client's activity genuinely triggers a mandatory reporting obligation. This meticulous process ensures that any reporting is accurate, timely, and legally defensible, thereby protecting both the firm and the client from potential penalties and reputational damage. It demonstrates a commitment to both regulatory adherence and ethical client service. An incorrect approach that involves immediate, unsolicited reporting without proper due diligence fails to respect client confidentiality and may lead to unnecessary scrutiny or alarm for the client. This could violate data protection principles and potentially breach contractual obligations of discretion. Another incorrect approach, which is to ignore the feedback entirely due to a desire to avoid any potential conflict or administrative burden, represents a serious regulatory failure. This inaction could lead to non-compliance with reporting mandates, resulting in significant fines, sanctions, and damage to the firm's reputation. A third incorrect approach, which is to report based on a vague suspicion without concrete evidence or a clear understanding of the reporting triggers, is also professionally unsound. This can lead to inaccurate reporting, wasting regulatory resources, and potentially implicating innocent parties. Professionals should employ a structured decision-making process when faced with such dilemmas. This involves 1. Identifying the core issue, a potential conflict between client confidentiality and regulatory reporting. 2. Gathering all relevant facts, understanding the nature of the stakeholder feedback and the client's activity. 3. Consulting applicable regulations and internal policies, determining the precise reporting obligations and any relevant thresholds or exceptions. 4. Assessing the risk, evaluating the potential consequences of both reporting and not reporting. 5. Seeking expert advice, consulting with compliance officers or legal counsel if necessary. 6. Documenting the decision-making process, maintaining a clear record of the steps taken and the rationale behind the final decision. Question 6. The performance metrics show a consistent pattern of transactions that, while individually small, collectively fall outside the firm's established anti-money laundering (AML) transaction monitoring thresholds for enhanced due diligence. The team lead suggests that these are likely legitimate, low-value customer activities, and that adjusting the threshold slightly to encompass these transactions would be a more efficient use of resources than investigating each one. Option A. Instruct the team to continue monitoring as usual, assuming that the low value of the transactions negates any significant AML risk and that the current system is sufficient. Option B. Implement a minor, undocumented adjustment to the transaction monitoring thresholds to capture these transactions, thereby bringing them within the system's expected parameters without further investigation. Option C. Advise the team lead that, while the transactions are low value, the pattern warrants attention, and suggest a targeted review of a sample of these transactions to understand the underlying activity before considering any threshold adjustments. Option D. Report the observed pattern to the compliance department immediately, requesting a review of the transaction monitoring thresholds and the associated alert generation logic to ensure ongoing regulatory compliance. The correct answer is D. Report the observed pattern to the compliance department immediately, requesting a review of the transaction monitoring thresholds and the associated alert generation logic to ensure ongoing regulatory compliance. Explanation: this scenario presents a professional challenge due to the inherent conflict between achieving performance targets and adhering to regulatory compliance. Pressure to meet metrics can tempt individuals to overlook or rationalize minor deviations from established procedures, which, while seemingly insignificant, can have serious regulatory and ethical ramifications. Careful judgment is required to prioritize compliance over short-term performance gains. The correct approach represents best professional practice because it directly addresses the identified compliance gap with a proactive and documented response. This aligns with the principles of regulatory adherence, which mandate that firms establish and maintain adequate systems and controls to prevent financial crime. By reporting the issue internally and initiating a review, the individual demonstrates a commitment to upholding the firm's regulatory obligations and mitigating potential risks. This proactive stance is crucial for demonstrating to regulators that the firm takes its compliance responsibilities seriously. An incorrect approach that involves ignoring the discrepancy or assuming it will resolve itself is professionally unacceptable. This failure to act constitutes a breach of the firm's duty to maintain effective controls and could be interpreted by regulators as a deliberate disregard for compliance requirements. Such inaction increases the firm's exposure to regulatory sanctions, reputational damage, and potential financial penalties. Another incorrect approach that involves making a superficial adjustment without proper investigation or documentation is also professionally unacceptable. This approach fails to address the root cause of the compliance issue and does not provide a clear audit trail for regulatory scrutiny. It creates a false sense of security while leaving the firm vulnerable to future breaches. This demonstrates a lack of due diligence and a failure to implement robust compliance procedures. The professional decision-making process for similar situations should involve a clear framework. 1. Identify the potential compliance issue. 2. Assess the severity and potential impact of the issue. 3. Consult internal policies and relevant regulatory guidance. 4. Report the issue through appropriate internal channels. 5. Cooperate fully with any subsequent investigation or remediation efforts. 6. Document all actions taken. This structured approach ensures that compliance is prioritized and that all necessary steps are taken to address issues effectively and ethically. Question 7. The evaluation methodology shows that a financial advisor has identified a series of unusually large and complex transactions for a long-standing client, which deviate significantly from their typical financial behavior. The advisor suspects these transactions might be linked to money laundering, but is hesitant to report them due to the client's importance to the firm and the potential for damaging the relationship. What is the most appropriate course of action for the advisor to take in accordance with regulatory frameworks and professional ethics? Option A. Immediately confront the client to demand an explanation for the transactions before taking any further steps. Option B. Discuss the client's transactions with other clients to gauge their opinions on how to proceed. Option C. Conduct a thorough internal review of the transactions. Document all findings, and if suspicion persists, confidentially report the activity to the relevant regulatory authority. Option D. Ignore the suspicious transactions to avoid upsetting the client and potentially losing their business. The correct answer is C. Conduct a thorough internal review of the transactions, document all findings, and if suspicion persists, confidentially report the activity to the relevant regulatory authority. Explanation: scenario analysis. This scenario presents a professional challenge due to the inherent conflict between client confidentiality and the regulatory obligation to report suspicious activities. A financial advisor must navigate this delicate balance, understanding that a failure to report could lead to severe regulatory penalties and reputational damage, while an unwarranted report could breach client trust and potentially harm the client's reputation. The advisor's judgment is critical in discerning genuine suspicion from mere unusual behavior. Correct approach analysis. The correct approach involves a thorough internal investigation and documentation of the suspicious activity, followed by a confidential report to the relevant regulatory authority if suspicion persists. This aligns with the Vinci hiring assessment test's emphasis on regulatory compliance, specifically the principles of anti-money laundering (AML) and counter-terrorist financing (CTF). By investigating internally, the advisor attempts to gather more information to confirm or refute their suspicions, thereby avoiding premature or unfounded reports. If suspicion remains, reporting to the Financial Intelligence Unit (FIU) is a mandatory regulatory requirement under the Proceeds of Crime Act 2002, as applicable in the UK context for this exam. This demonstrates adherence to legal obligations while attempting to uphold professional integrity and client relationships as much as possible within the bounds of the law. Incorrect approaches analysis. One incorrect approach involves ignoring the suspicious transaction due to the client's long-standing relationship and the potential for client dissatisfaction. This is a direct violation of AML/CTF regulations, which mandate reporting regardless of client status or potential repercussions. Ethically, it represents a failure to act with due diligence and a dereliction of professional duty to protect the financial system from illicit activities. Another incorrect approach is to immediately confront the client and demand an explanation for the transaction without first conducting an internal review or reporting. This could tip off the client, allowing them to conceal or move illicit funds, thereby obstructing a potential investigation. It also risks breaching client confidentiality unnecessarily if the suspicion is ultimately unfounded. Furthermore, it bypasses the established regulatory reporting channels. A third incorrect approach is to seek advice from other clients about how they would handle such a situation. This is a severe breach of client confidentiality, as it involves discussing one client's potentially sensitive financial activity with unrelated third parties. It also demonstrates a lack of understanding of internal compliance procedures and professional ethics. Professional reasoning. Professionals in financial services must develop a robust decision-making framework that prioritizes regulatory compliance and ethical conduct. This framework should include 1. Vigilance, actively monitoring client activities for any unusual or suspicious patterns. 2. Due diligence, conducting thorough internal investigations when suspicions arise, gathering all relevant facts and documentation. 3. Reporting obligations, understanding and adhering to mandatory reporting requirements to regulatory bodies. 4. Confidentiality, maintaining client confidentiality unless legally obligated to disclose information. 5. Seeking internal guidance, consulting with compliance officers or legal counsel within the organization when uncertain about a situation. This systematic approach ensures that regulatory obligations are met, ethical standards are upheld, and the integrity of the financial system is protected. Question 8. Risk assessment procedures indicate that a new, high-net-worth individual client is eager to open an account and begin trading immediately, citing a time-sensitive investment opportunity. The client has provided initial identification documents, but the full verification of beneficial ownership and the source of their substantial funds is still pending completion by the compliance team. What is the most appropriate course of action to ensure regulatory compliance? Option A. Accept the client's provided identification documents at face value and proceed with onboarding, as the client appears reputable and the opportunity is time-sensitive. Option B. Inform the client that the account cannot be opened and trading cannot commence until all mandatory Know Your Customer (KIC) and anti-money laundering (AML) due diligence procedures have been fully completed and verified. Option C. Open the account but restrict all trading activity until the due diligence is finalized, and then inform the client of the temporary limitations. Option D. Proceed with onboarding the client and completing the full due diligence checks within the next 48 hours while monitoring their initial transactions closely. The correct answer is D. Proceed with onboarding the client and completing the full due diligence checks within the next 48 hours while monitoring their initial transactions closely. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between a firm's desire to expand its client base and the regulatory imperative to conduct thorough due diligence. The pressure to onboard a new, potentially lucrative client quickly can lead to shortcuts in the Know Your Customer (KIC) and anti-money laundering (AML) processes. This creates a significant risk of facilitating financial crime, which carries severe legal, reputational, and financial consequences for the firm and its employees. The challenge lies in balancing business objectives with regulatory obligations, requiring careful judgment and adherence to established procedures. Correct approach analysis. The correct approach emphasizes the paramount importance of completing all mandatory due diligence checks before onboarding the client. This aligns directly with the principles of robust regulatory compliance, specifically concerning AML and counter-terrorist financing, CTF, regulations. By insisting on the full KYC process, including verification of beneficial ownership and source of funds, the firm upholds its legal and ethical obligations to prevent its services from being used for illicit purposes. This proactive stance mitigates the risk of regulatory sanctions, reputational damage, and potential involvement in financial crime. It demonstrates a commitment to integrity and responsible business conduct, which are foundational to long-term success and trust within the financial industry. Incorrect approaches analysis. One incorrect approach involves proceeding with onboarding the client while deferring the full due diligence to a later date. This is a direct violation of AML/CTF regulations that mandate comprehensive due diligence prior to establishing a business relationship. It creates a window of opportunity for illicit funds to enter the financial system, exposing the firm to significant regulatory penalties and reputational harm. Ethically, it demonstrates a disregard for the firm's responsibility to combat financial crime. Another incorrect approach is to rely solely on the client's provided documentation without independent verification. While client-provided information is a starting point, regulatory frameworks require firms to take reasonable steps to verify the accuracy and completeness of this information. Failing to do so, especially for high-risk clients or transactions, can be seen as willful blindness and a failure to implement adequate controls, leading to regulatory sanctions. A third incorrect approach is to onboard the client but restrict their activities until due diligence is complete. While this might seem like a compromise, it still falls short of full compliance. Many regulations require the establishment of the business relationship itself to be contingent on satisfactory due diligence. Furthermore, even restricted activities can carry risks, and the delay in full verification still exposes the firm to potential issues if the client's activities, even if limited, are linked to illicit finance. Professional reasoning. Professionals facing such a situation should adopt a risk-based approach that prioritizes regulatory compliance. The decision-making process should involve 1. Identifying the core regulatory requirements for client onboarding, KIC/AML/CTF. 2. Assessing the risks associated with the specific client and the proposed business relationship. 3. Adhering strictly to the firm's established policies and procedures for due diligence. 4. Escalating any concerns or requests for exceptions to senior management or the compliance department. 5. Understanding that business objectives should never override fundamental regulatory and ethical obligations. 6. Documenting all decisions and the rationale behind them. Question 9. Operational review demonstrates that a newly enacted regulation, effective in 3 months, contains several clauses that are open to multiple interpretations regarding client onboarding procedures. The compliance team has identified significant potential operational impacts depending on the chosen interpretation. What is the most appropriate course of action for the firm to ensure compliance? Option A. Implement the most conservative interpretation of the regulation to minimize any potential for non-compliance, even if it leads to increased operational costs. Option B. Adopt a minimal compliance approach, making only the most essential changes, and observe how the regulation is enforced and interpreted by others in the market. Option C. Rely solely on the interpretation provided by the firm's internal legal counsel and proceed with implementation based on that advice. Option D. Proactively engage with the relevant regulatory body to seek formal clarification on the ambiguous clauses. The correct answer is D. Proactively engage with the relevant regulatory body to seek formal clarification on the ambiguous clauses. Explanation. Scenario analysis. This scenario presents a common challenge in regulatory compliance where a new, complex regulation requires interpretation and implementation within a tight timeframe. The firm must balance the need for swift action with the imperative to ensure accuracy and adherence to the spirit and letter of the law. The risk lies in either overinterpreting the regulation, leading to unnecessary operational changes and costs, or underinterpreting it, resulting in non-compliance and potential penalties. The pressure to meet deadlines can exacerbate these risks, making a structured, informed approach critical. Correct approach analysis. The correct approach involves seeking clarification from the relevant regulatory body. This is best professional practice because it directly addresses the ambiguity in the regulation. By engaging with the regulator, the firm obtains an authoritative interpretation, ensuring that its implementation plan aligns with regulatory expectations. This proactive step mitigates the risk of non-compliance and avoids costly rework. It demonstrates a commitment to regulatory adherence and a responsible approach to complex compliance challenges. This aligns with the principles of due diligence and acting in good faith, which are fundamental to regulatory compliance frameworks. Incorrect approaches analysis. Implementing a conservative interpretation without seeking clarification is professionally unacceptable because it assumes a level of certainty that may not exist. While seemingly cautious, it can lead to overcompliance, incurring unnecessary costs and operational inefficiencies. More importantly, if the regulator's actual interpretation differs significantly, the firm could still be found non-compliant. This approach fails to demonstrate sufficient effort to understand and comply with the regulation accurately. Relying solely on internal legal counsel's interpretation without external validation is also problematic. While internal counsel provides valuable expertise, their interpretation may not always reflect the regulator's precise intent, especially with novel or complex regulations. This can lead to a misinterpretation that, while made in good faith, still results in non-compliance. It bypasses the most direct route to understanding regulatory expectations. Adopting a wait-and-see approach, where the firm implements minimal changes and observes how other firms are affected or how the regulator enforces the rule, is a significant regulatory and ethical failure. This passive stance demonstrates a lack of proactive compliance and a willingness to risk non-compliance. It can lead to significant penalties if the firm's actions are later deemed to be in breach of the regulation. This approach prioritizes expediency over diligent compliance and can be seen as an attempt to circumvent regulatory obligations. Professional reasoning. When faced with ambiguous or complex regulations, professionals should adopt a structured decision-making process. First, thoroughly review the regulation and identify areas of ambiguity. Second, consult internal subject matter experts and legal counsel. Third, if ambiguity persists and the impact is significant, proactively seek clarification from the relevant regulatory authority. Document all steps taken, including the rationale for decisions and any advice received. This systematic approach ensures that compliance efforts are well-informed, defensible, and aligned with regulatory requirements, minimizing risk and upholding professional standards. Question 10. The monitoring system demonstrates an intermittent anomaly in transaction reporting that, while infrequent, deviates from established reporting protocols. The system is scheduled for an upgrade in 6 months, which is expected to resolve such minor discrepancies. What is the most appropriate course of action for the firm? Option A. Document the anomaly and await the system upgrade to address it. Option B. Escalate the anomaly to the compliance department for immediate review and guidance. Option C. Ignore the anomaly as it is infrequent and will be resolved by the system upgrade. Option D. Attempt to resolve the anomaly internally without involving the compliance department. The correct answer is B. Escalate the anomaly to the compliance department for immediate review and guidance. Explanation. This scenario presents a professional challenge due to the inherent tension between operational efficiency and robust regulatory compliance. The firm is expected to maintain a high standard of oversight, yet the monitoring system's limitations create a potential gap. The core difficulty lies in balancing the need to identify and address potential breaches promptly with the practical constraints of the existing technology and resources. Careful judgment is required to determine the most effective and compliant course of action without compromising client interests or regulatory obligations. The correct approach represents best professional practice because it prioritizes proactive risk mitigation and adherence to the spirit and letter of regulatory requirements. By escalating the observed anomaly to the compliance department, the firm is demonstrating a commitment to transparency and due diligence. This action ensures that a qualified team, equipped to interpret complex regulatory landscapes and assess potential implications, can thoroughly investigate the issue. This aligns with the principles of good governance and the regulatory expectation that firms will have mechanisms in place to identify and rectify potential compliance breaches, even if those mechanisms are not perfectly automated. An incorrect approach that involves ignoring the anomaly due to its infrequent occurrence is professionally unacceptable. This failure constitutes a breach of the firm's duty of care and potentially violates regulatory mandates that require diligent oversight and reporting of suspicious activities. Such an action could lead to significant regulatory penalties, reputational damage, and harm to clients. Another incorrect approach, such as attempting to resolve the anomaly internally without involving compliance, is also professionally unacceptable. This bypasses the established governance structure and deprives the firm of expert regulatory interpretation. It risks misinterpreting the anomaly, applying an inappropriate fix, or failing to recognize a systemic issue that requires broader remediation. This approach demonstrates a lack of understanding of the importance of specialized compliance functions and the potential for even minor deviations to signal larger problems. A further incorrect approach, such as documenting the anomaly but taking no immediate action pending further system upgrades, is also professionally unacceptable. While system upgrades are important, delaying action on a known potential compliance issue is a failure to act with reasonable promptness. Regulatory frameworks often emphasize timely identification and remediation of risks. Waiting for a future upgrade without addressing the current observed issue could be seen as a deliberate or negligent disregard for immediate compliance obligations. The professional decision-making process for similar situations should involve a clear escalation protocol. When a monitoring system flags a potential issue, the first step is to assess its nature and potential impact. If the issue suggests a possible breach of regulatory requirements or ethical standards, the immediate and correct course of action is to escalate it to the relevant internal department, typically compliance or legal. This ensures that the matter is handled by individuals with the expertise to interpret regulations, assess risk, and implement appropriate corrective actions. Professionals should always err on the side of caution and transparency when dealing with potential compliance matters, prioritizing regulatory adherence and client protection over expediency. Question 11. Assessment of a financial advisor's response when a client proposes a tax strategy that appears aggressive and potentially skirts the edges of tax avoidance versus evasion, with the advisor having a duty to ensure compliance with relevant financial regulations and anti-money laundering AML guidelines. Option A. Immediately implement the client's proposed strategy to satisfy their request, assuming the client is acting in good faith. Option B. Advise the client that the proposed strategy may be non-compliant and explore alternative, legally sound tax planning options, while documenting all discussions and advice. Option C. Inform the client that the firm cannot assist with strategies that are perceived as aggressive, without further investigation into the legality of the proposal. Option D. Proceed with the client's strategy, but omit any mention of potential risks or regulatory scrutiny to the client, focusing solely on the perceived benefit. The correct answer is B. Advise the client that the proposed strategy may be non-compliant and explore alternative, legally sound tax planning options, while documenting all discussions and advice. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between a client's explicit instructions and the firm's regulatory obligations. The firm must navigate the client's desire for a specific, potentially aggressive tax strategy against the backdrop of its duty to ensure compliance with tax laws and prevent financial crime. The challenge lies in balancing client service with the paramount importance of adhering to legal and ethical standards, especially when the client's request might border on or cross into non-compliance. Correct approach analysis. The correct approach demonstrates best professional practice by prioritizing regulatory compliance and ethical conduct. It involves a thorough review of the proposed strategy against current tax legislation and anti-money laundering (AML) regulations. This proactive stance ensures that the firm is not facilitating tax evasion or any illicit financial activities. By seeking clarification and potentially advising against the strategy if it appears non-compliant, the firm upholds its professional integrity and its duty to the regulatory bodies. This aligns with the principles of responsible financial advice and the prevention of financial crime, which are core tenets of regulatory frameworks governing financial services. Incorrect approach is analysis. One incorrect approach involves immediately implementing the client's strategy without further scrutiny. This fails to meet the firm's regulatory obligations to conduct due diligence and ensure compliance. It could lead to the firm being complicit in tax evasion or money laundering, resulting in severe penalties, reputational damage, and potential loss of license. This approach disregards the firm's responsibility to act ethically and within the bounds of the law. Another incorrect approach is to dismiss the client's request outright without understanding the underlying rationale or exploring compliant alternatives. Caution is necessary. An overly rigid or uncommunicative stance can damage client relationships and may overlook legitimate tax planning opportunities that are within legal boundaries. This approach fails to demonstrate professional diligence in understanding the client's needs while still upholding compliance. A third incorrect approach is to proceed with the strategy while downplaying the potential risks or misrepresenting its compliance status to the client. This constitutes a serious ethical and regulatory breach. It involves a lack of transparency and honesty, potentially exposing both the client and the firm to significant legal repercussions. Such an action undermines trust and violates the fundamental principles of professional conduct. Professional reasoning. Professionals should adopt a framework that begins with understanding the client's objectives. This understanding must then be rigorously assessed against all applicable laws, regulations, and ethical guidelines. If a proposed strategy raises red flags concerning compliance or ethical standards, the professional's duty is to investigate further, seek expert advice if necessary, and communicate any concerns or limitations clearly and transparently to the client. The ultimate decision must be to act in a manner that is both legally compliant and ethically sound, even if it means advising against the client's initial preference. This involves a commitment to ongoing learning and adherence to professional standards. Question 12. Comparative studies suggest that the effectiveness of a firm's risk mitigation strategies is best evaluated through a dynamic and forward-looking lens. Considering the Vinci hiring assessment tests emphasis on regulatory compliance and robust risk management. Which of the following approaches to assessing the effectiveness of existing risk mitigation strategies in a rapidly evolving market environment would be considered most professionally sound and compliant with regulatory expectations? Option A. Initiating a comprehensive review of risk mitigation strategies only after a significant operational failure or market downturn has occurred. Option B. Regularly conducting stress tests and scenario analyses that simulate plausible adverse market conditions to gauge the resilience of mitigation controls. Option C. Performing a purely qualitative assessment of risk mitigation effectiveness based on anecdotal evidence and team consensus. Option D. Relying primarily on historical data from past risk events to confirm that existing controls have performed adequately in previous situations. Correct answer is B. Regularly conducting stress tests and scenario analyses that simulate plausible adverse market conditions to gauge the resilience of mitigation controls. Explanation. Scenario analysis. This scenario presents a professional challenge in risk assessment by requiring an individual to evaluate the effectiveness of a firm's risk mitigation strategies in the context of evolving market conditions. The challenge lies in moving beyond a static, checklist-based approach to risk assessment, and instead adopting a dynamic, forward-looking perspective that considers the potential impact of unforeseen events and the interconnectedness of various risk factors. This requires judgment, foresight, and an understanding of how theoretical risk frameworks translate into practical operational resilience. Correct approach analysis. The correct approach involves a proactive and adaptive risk assessment methodology. This best professional practice aligns with regulatory expectation that firms should not only identify and assess risks, but also continuously monitor and test the effectiveness of their controls in response to changing circumstances. Specifically, regulators often emphasize the importance of scenario analysis and stress testing to understand potential vulnerabilities under adverse conditions. This approach demonstrates a commitment to robust risk management, ensuring that the firm's risk appetite remains appropriate and that mitigation strategies are not merely documented but are demonstrably effective in practice. It reflects a deep understanding of the firm's risk profile and its exposure to both known and emerging threats, thereby safeguarding client assets and maintaining market integrity. Incorrect approaches analysis. One incorrect approach focuses solely on historical data and past performance. This fails to acknowledge that past risk events are not necessarily indicative of future outcomes, especially in dynamic financial markets. Regulatory frameworks often caution against complacency based on historical data alone, as it can lead to a false sense of security and an underestimation of emerging risks. This approach represents a failure to adapt risk assessment to current and future market reality, potentially violating principles of prudent risk management. Another incorrect approach relies on a purely qualitative assessment without any form of validation or stress testing. While qualitative assessment is a component of risk assessment, relying on it exclusively without quantitative or scenario-based validation can lead to subjective biases and an incomplete understanding of the magnitude of potential risks. Regulators expect a balanced approach that combines qualitative insights with more objective measures to ensure that risk assessments are comprehensive and reliable. This approach risks overlooking significant vulnerabilities due to a lack of rigorous testing. A third incorrect approach involves a reactive stance, where risk assessments are only conducted after a significant risk event has occurred. This is fundamentally contrary to the principles of proactive risk management. Regulatory bodies mandate that firms have systems and controls in place to identify and manage risks before they materialize into losses or breaches. Reactive approach indicates a significant deficiency in the firm's risk management framework and a failure to meet regulatory obligations for ongoing risk oversight. Professional reasoning. Professionals should approach risk assessment with a mindset of continuous improvement and adaptation. The decision-making process should involve 1. Understanding the firm's strategic objectives and risk appetite. 2. Identifying all relevant risk categories, including market, credit, operational, liquidity, and reputational risks. 3. Employing a combination of qualitative and quantitative assessment techniques, including scenario analysis and stress testing, to evaluate the potential impact and likelihood of identified risks. 4. Regularly reviewing and updating risk assessments in light of internal and external changes, such as new products, market volatility, or regulatory updates. 5. Documenting the risk assessment process and the rationale for decisions made. 6. Ensuring that risk mitigation strategies are effectively implemented and regularly tested for their efficacy. This systematic and forward-looking approach ensures that risk management remains a dynamic and integral part of business operations, rather than a static compliance exercise. Question 13. Strategic planning requires a robust framework for assessing potential risks associated with new product development. Considering the pressure to launch a novel financial instrument quickly into a volatile market, which of the following approaches to risk assessment would best align with professional best practices and regulatory expectations? Option A. Focusing exclusively on the immediate competitive advantages and revenue potential, deferring detailed risk assessment until after the product has been launched and initial sales are realized. Option B. Relying primarily on historical performance data of similar, but not identical, products to infer the risk profile of the new instrument. Option C. Gathering informal feedback from a few experienced colleagues and clients to gauge their perception of potential risks. Option D. Conducting a comprehensive scenario analysis that considers a wide range of potential market movements and operational disruptions, and developing mitigation strategies for the most probable and impactful risks identified. The correct answer is D. Conducting a comprehensive scenario analysis that considers a wide range of potential market movements and operational disruptions, and developing mitigation strategies for the most probable and impactful risks identified. Explanation. This scenario presents a professional challenge because it requires balancing the need for robust risk assessment with the practical constraints of a rapidly evolving market and limited initial data. The firm is under pressure to launch a new product quickly, which can lead to a temptation to shortcut or downplay potential risks. Effective risk assessment in this context demands a proactive, forward-looking approach that anticipates potential issues rather than merely reacting to them. The correct approach represents best professional practice because it prioritizes a comprehensive and systematic evaluation of potential risks before product launch. This aligns with regulatory expectations for due diligence and responsible product development, ensuring that the firm acts in the best interests of its clients and the market. By identifying and assessing risks early, the firm can implement appropriate mitigation strategies, thereby safeguarding its reputation and financial stability. This proactive stance is a cornerstone of sound financial management and regulatory compliance. An incorrect approach that focuses solely on historical data would be professionally unacceptable. This fails to account for the unique characteristics of the new product and the dynamic market conditions, potentially leading to the oversight of novel or amplified risks. It represents a failure in due diligence and a disregard for the principle of forward-looking risk management, which is a key expectation under regulatory frameworks governing financial product development. Another incorrect approach that relies heavily on anecdotal evidence from a small sample size is also professionally unsound. Anecdotal evidence is inherently subjective and lacks the statistical rigor required for a reliable risk assessment. This approach risks making decisions based on incomplete or biased information, which could lead to significant unforeseen losses or client detriment. It demonstrates a lack of commitment to a data-driven and objective risk assessment process, a fundamental ethical and regulatory requirement. A third incorrect approach that prioritizes speed of market entry over thorough risk assessment is a direct contravention of professional duty. While market timing is important, it should not come at the expense of prudent risk management. This approach suggests a willingness to accept potentially catastrophic risks for short-term gains, which is both ethically questionable and likely to violate regulatory mandates that require firms to manage risks effectively. The professional decision-making process for similar situations should involve a structured risk management framework. This framework should include 1. Risk identification, brainstorming and documenting all potential risks associated with the new product and its market. 2. Risk analysis, evaluating the likelihood and potential impact of each identified risk. 3. Risk evaluation, prioritizing risks based on their severity. 4. Risk treatment, developing and implementing strategies to mitigate, transfer, avoid, or accept identified risks. 5. Risk monitoring and review, continuously tracking identified risks and reassessing the risk landscape. This systematic process ensures that decisions are informed, objective, and compliant with regulatory and ethical standards. Question 14. To address the challenge of proactively identifying and evaluating potential future threats to the firm's operational and financial stability, which risk assessment approach would be most appropriate for a compliance officer to recommend, considering the need to anticipate and mitigate risks before they materialize? Option A. A quantitative analysis based solely on historical loss data from past incidents. Option B. A qualitative assessment focusing on the likelihood and potential impact of hypothetical future events. Option C. A reactive review of recent operational failures to identify immediate control gaps. Option D. An assessment that prioritizes risks with readily available statistical data, ignoring qualitative factors. The correct answer is B. A qualitative assessment focusing on the likelihood and potential impact of hypothetical future events. Explanation. This scenario presents a professional challenge because it requires an individual to move beyond a superficial understanding of risk assessment and apply it in a dynamic, potentially ambiguous situation. The challenge lies in identifying the most appropriate method for assessing risk when faced with incomplete information and a need for a forward-looking perspective, rather than a purely historical or reactive one. Careful judgment is required to select a methodology that aligns with regulatory expectations for proactive risk management. The correct approach represents best professional practice because it emphasizes a forward-looking, qualitative assessment of potential future events and their impact. This aligns with regulatory frameworks that mandate firms to identify, assess, and manage risks on an ongoing basis, not just react to past incidents. By focusing on the likelihood and impact of potential future events, this method allows for the development of preventative controls and strategic responses, which is a cornerstone of robust risk management and compliance with principles of good governance and prudential supervision. An incorrect approach that relies solely on historical data fails to adequately address emerging risks or changes in the business environment. This can lead to a false sense of security and a failure to implement necessary controls for new threats, potentially violating regulatory expectations for a comprehensive and forward-looking risk assessment. Another incorrect approach that focuses only on quantifiable risks overlooks qualitative risks such as reputational damage, operational disruptions due to human error, or strategic missteps, which are often significant and difficult to quantify, but are critical components of a holistic risk assessment. This selective focus can result in regulatory breaches if material risks are not identified and managed. A third incorrect approach that prioritizes immediate operational issues without considering their systemic implications or potential for escalation fails to adopt a strategic risk management perspective. This can lead to a fragmented approach to risk, where individual problems are addressed in isolation without understanding their broader impact on the firm's risk profile, which is contrary to the integrated risk management principles often espoused by regulators. Professionals should use a decision-making framework that begins with understanding the specific regulatory context and the firm's risk appetite. They should then consider the nature of the risks being assessed. Are they historical, emerging, qualitative, or quantitative? The next step involves evaluating different risk assessment methodologies against these considerations, prioritizing those that offer a forward-looking and comprehensive view. Finally, the chosen methodology should be applied consistently and reviewed regularly to ensure its continued relevance and effectiveness in identifying and managing material risks. Question 15. Cost-benefit analysis shows that launching a new, innovative financial product could yield significant profits, but the internal risk assessment team has flagged several potential operational and market risks that are difficult to quantify due to the product's novelty. The product development team is pushing for an immediate launch to capture first-mover advantage. Which approach best balances the potential rewards with prudent risk management? Option A, proceed with the launch, implementing a phased risk monitoring plan post-launch to address any emerging issues as they arise. Option B, delay the launch until a comprehensive, fully quantified risk assessment can be completed, even if it means losing the first-mover advantage. Option C, delegate the risk assessment to the sales team, as they are most familiar with market demands and potential customer reactions. Option D, conduct a qualitative risk assessment, focusing on the most probable high-impact risks and developing robust mitigation strategies for those, while proceeding with a slightly delayed launch. The correct answer is A, proceed with the launch, implementing a phased risk monitoring plan post-launch to address any emerging issues as they arise. Explanation. This scenario presents a professional challenge because it requires balancing the potential financial benefits of a new product launch against the inherent risks associated with inadequate risk assessment. The core of the challenge lies in determining the appropriate level of risk mitigation when faced with incomplete data and the pressure to proceed quickly. Careful judgment is required to ensure that the pursuit of profit does not lead to regulatory noncompliance or ethical breaches. The correct approach represents best professional practice because it prioritizes a thorough and documented risk assessment process, even when time is limited. This aligns with regulatory expectations for robust risk management frameworks, which are designed to protect investors and market integrity. By identifying, assessing, and planning for potential risks, the firm demonstrates a commitment to responsible business conduct and adherence to principles of good governance. This proactive stance helps prevent future financial losses and reputational damage, which are often far more costly than the initial investment in a comprehensive risk assessment. An incorrect approach that relies solely on historical data without considering the unique aspects of the new product would be professionally unacceptable. This fails to acknowledge that past performance is not always indicative of future results, especially with novel offerings. Such an approach could lead to underestimating or entirely missing critical risks, potentially violating regulatory requirements for due diligence and risk management. Another incorrect approach, which involves deferring risk assessment to a later stage, demonstrates a disregard for the foundational principles of risk management. This is ethically problematic as it prioritizes expediency over prudence, potentially exposing the firm and its stakeholders to unforeseen and unmitigated dangers. This also contravenes regulatory mandates that often require risk assessments to be conducted before significant decisions are made or actions are taken. The professional decision-making process for similar situations should involve a structured approach. First, clearly define the objectives and scope of the risk assessment. Second, identify all potential risks, considering both internal and external factors and the specific context of the new product. Third, assess the likelihood and impact of each identified risk. Fourth, develop appropriate mitigation strategies and contingency plans. Finally, document the entire process and ensure that findings are communicated to relevant stakeholders for informed decision-making. This systematic approach ensures that all relevant factors are considered, leading to more robust and defensible risk management decisions. Question 16. Quality control measures reveal that the risk assessment report for a new financial product was primarily prepared by the product development team, with limited input from the independent risk management function. The report heavily relies on historical performance data of similar, but not identical, products, and does not explicitly detail potential operational or reputational risks. Which approach to validating and refining this risk assessment would best uphold professional standards and regulatory expectations? Option A. Ask the business unit that will market the product to provide their own risk assessment to supplement the existing report. Option B. Commission an independent third-party risk assessment firm to conduct a comprehensive review of the new product's risks, incorporating qualitative and forward-looking factors. Option C. Accept the report as is, assuming the product development team has sufficient expertise to identify all relevant risks. Option D. Request the internal risk management team to simply add a disclaimer to the existing report, acknowledging potential limitations. The correct answer is B. Commission an independent third-party risk assessment firm to conduct a comprehensive review of the new product's risks, incorporating qualitative and forward-looking factors. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires an individual to move beyond a superficial understanding of risk assessment and apply it to a nuanced situation involving potential conflicts of interest and regulatory compliance. The challenge lies in identifying the most appropriate method for assessing risk when the data source itself might be compromised or biased, necessitating a robust and independent evaluation. Careful judgment is required to select an approach that upholds regulatory standards and ethical obligations, particularly in a financial services context where client trust and market integrity are paramount. Correct approach analysis. The correct approach involves conducting an independent, third-party risk assessment. This represents best professional practice because it mitigates the inherent bias that could arise from internal assessments, especially when those assessments are influenced by individuals or departments with vested interests. Regulatory frameworks, such as those governing financial services, e.g., FCA principles in the UK or SEC regulations in the US, depending on the exam-specified jurisdiction, often mandate or strongly encourage independent oversight for critical risk functions to ensure objectivity and compliance. This approach aligns with the ethical principle of acting with integrity and due care, as it prioritizes an unbiased evaluation of potential risks to the firm and its clients. Incorrect approaches analysis, relying solely on the internal risk management team's existing documentation, without further validation or independent review, is professionally unacceptable. This fails to address the potential for ingrained biases or outdated methodologies within the internal team. It could lead to a regulatory failure if the assessment does not meet the required standards of objectivity and thoroughness mandated by the relevant authorities. Accepting the assessment provided by the business unit directly responsible for the product or service in question is also professionally unacceptable. This creates a significant conflict of interest, as the business unit may be incentivized to downplay or overlook risks to protect revenue or performance metrics. This approach directly contravenes ethical obligations to act in the best interests of the firm and its clients, and would likely be a clear violation of regulatory principles requiring independent risk oversight. Focusing exclusively on the historical performance data of the product without considering forward-looking qualitative risk factors is professionally unacceptable. While historical data is a component of risk assessment, it does not capture emerging threats, changes in the market, or operational vulnerabilities. A regulatory failure would occur if the risk assessment is deemed incomplete or inadequate by the regulator due to its narrow scope. Professional reasoning. Professionals should adopt a decision-making framework that prioritizes independence and objectivity in risk assessment. This involves 1. Identifying the potential for bias or conflict of interest in any data source or assessment. 2. Determining whether regulatory requirements mandate independent review or a specific methodology. 3. Seeking external validation or conducting independent assessments when internal processes may be compromised. 4. Considering both quantitative and qualitative factors for a comprehensive risk picture. 5. documenting the rationale for the chosen risk assessment approach and any limitations. Question 17. Cost-benefit analysis shows that launching a new, innovative financial product could significantly increase revenue, but the underlying technology is untested in the market. Which approach best aligns with prudent risk management and regulatory expectations for a firm like Vinci? Option A. Acknowledge the risks but dismiss them as unlikely to materialize given the perceived market demand for the product. Option B. Conduct a thorough risk assessment, quantifying potential losses, evaluating mitigation strategies, and ensuring residual risk is within the firm's appetite before proceeding. Option C. Focus solely on the projected revenue figures, as the potential upside outweighs the speculative nature of the risks. Option D. Prioritize speed to market to capture early revenue, assuming that any significant risks will be manageable if they arise. The correct answer is B. Conduct a thorough risk assessment, quantifying potential losses, evaluating mitigation strategies, and ensuring residual risk is within the firm's appetite before proceeding. Explanation. This scenario presents a professional challenge because it requires balancing the potential financial benefits of a new product launch against the inherent risks associated with its novel technology. The firm must not only assess the likelihood and impact of these risks, but also determine if the potential rewards justify the exposure. Careful judgment is required to ensure that the pursuit of profit does not lead to a disregard for client well-being or regulatory compliance. The correct approach represents best professional practice because it prioritizes a comprehensive and systematic evaluation of all identified risks. This involves quantifying potential losses, considering mitigation strategies, and ensuring that the residual risk is acceptable within the firm's risk appetite and regulatory obligations. Adhering to a structured risk assessment framework, such as that outlined by Vinci's internal guidelines and relevant financial conduct regulations, demonstrates a commitment to prudent management and client protection. This proactive stance helps prevent unforeseen losses and maintains the firm's reputation and solvency. An incorrect approach that focuses solely on the projected revenue without adequately assessing the downside risks is professionally unacceptable. This would constitute a failure to comply with regulatory expectations for robust risk management, potentially leading to significant financial losses that could jeopardize the firm's stability and its ability to serve clients. Another incorrect approach that dismisses potential risks as unlikely or unquantifiable, without a reasoned basis, ignores the fundamental principles of due diligence and prudent financial management. This oversight could lead to regulatory sanctions, reputational damage, and client dissatisfaction if adverse events materialize. A third incorrect approach that prioritizes speed to market over thorough risk assessment, even if the risks are acknowledged, demonstrates a disregard for the potential consequences of inadequate preparation. This can result in operational failures, compliance breaches, and ultimately harm to clients and the firm. The professional decision-making process for similar situations should involve a multi-stage approach. First, clearly define the scope of the risk assessment and identify all potential risks associated with the new product, including market, operational, technological, and regulatory risks. Second, analyze the likelihood and potential impact of each identified risk. Third, evaluate existing controls and develop mitigation strategies for significant risks. Fourth, determine the residual risk and compare it against the firm's established risk appetite. Finally, document the entire process and obtain appropriate internal approvals before proceeding. This structured approach ensures that all relevant factors are considered, promoting informed decision-making and adherence to professional standards. Question 18. Consider a scenario where a financial advisory firm is tasked with conducting a comprehensive risk assessment for a new investment product launch. The internal deadline for the assessment report is aggressive, and the team has access to a significant amount of historical market data related to similar products. What is the most appropriate approach to ensure a robust and compliant risk assessment under these circumstances? Option A. Delegate the risk assessment to junior staff with instructions to focus only on the readily available historical data to expedite the process. Option B. Systematically identify all potential risks associated with the new product, analyze their likelihood and impact using a combination of historical data and expert judgment, and then evaluate these risks to prioritize mitigation efforts. Option C. Quickly compile a report based on the most obvious risks identified from the historical data, prioritizing speed to meet the internal deadline. Option D. Primarily focus on analyzing the historical data of similar products to identify any past issues, assuming that these are the most probable risks for the new product. The correct answer is B. Systematically identify all potential risks associated with the new product, analyze their likelihood and impact using a combination of historical data and expert judgment, and then evaluate these risks to prioritize mitigation efforts. Explanation: scenario analysis. This scenario presents a professional challenge because it requires an individual to balance the need for timely information gathering with the imperative to conduct a thorough and unbiased risk assessment. The pressure to deliver a report quickly can lead to shortcuts, potentially overlooking critical risk factors or relying on incomplete data. The inherent subjectivity in risk assessment, even with established frameworks, necessitates a disciplined approach to avoid confirmation bias or the premature dismissal of potential threats. Correct approach analysis. The correct approach involves a systematic and iterative process of risk identification, analysis, and evaluation. This aligns with best professional practice by ensuring that all potential risks are considered, their likelihood and impact are assessed objectively, and appropriate mitigation strategies are developed. Specifically, this approach adheres to the principles of robust risk management frameworks, which are often mandated or strongly recommended by regulatory bodies. It emphasizes the importance of diverse data sources, expert consultation, and a structured methodology to minimize bias and ensure comprehensive coverage. This methodical process is crucial for fulfilling regulatory obligations related to risk management and for providing stakeholders with a reliable assessment of potential threats. Incorrect approaches analysis. Focusing solely on readily available information without actively seeking out potential risks represents a failure to conduct a comprehensive risk identification. This approach is ethically questionable as it may lead to an incomplete picture of the risk landscape, potentially exposing the firm and its clients to unforeseen dangers. Also fails to meet regulatory expectations for proactive risk management. Prioritizing speed over thoroughness by skipping the analysis and evaluation stages is a significant regulatory and ethical failure. This bypasses the core purpose of risk assessment, which is to understand the nature and magnitude of identified risks. Such an approach could lead to misallocation of resources, ineffective mitigation strategies, and ultimately, a breach of duty of care. Relying exclusively on historical data without considering emerging or novel risks is another critical flaw. While historical data provides valuable insights, it is insufficient on its own. Regulatory frameworks often require forward-looking risk assessments that account for evolving market conditions, technological advancements, and geopolitical shifts. Ignoring these dynamic elements is a failure to adapt and manage contemporary risks effectively. Professional reasoning. Professionals should approach risk assessment with a structured methodology, beginning with a clear definition of the scope and objectives. This involves identifying all potential risk categories relevant to the specific context. Subsequently, each identified risk should be analyzed for its likelihood of occurrence and potential impact, utilizing a range of qualitative and quantitative tools where appropriate. The evaluation phase then prioritizes risks based on their severity, informing the development of appropriate mitigation and response plans. This iterative process should be documented thoroughly, and findings should be communicated clearly to relevant stakeholders. Continuous monitoring and review are essential to ensure the risk assessment remains relevant and effective. Question 19. The investigation demonstrates that the firm's risk assessment process has historically relied heavily on analyzing past incidents to identify potential future threats. While this has helped in addressing recurring issues, it has not adequately prepared the firm for novel or evolving risks. Which of the following approaches to risk assessment best aligns with current regulatory expectations for a forward-looking and comprehensive evaluation? Option A. Implementing a scenario-based risk assessment methodology that explores hypothetical future events and their potential impact, alongside a continuous monitoring system for emerging threats. Option B. Focusing risk assessment efforts exclusively on identifying and quantifying risks that have the highest potential financial losses, regardless of their likelihood. Option C. Expanding the historical data analysis to include a wider range of past events, assuming that future risks will be variations of past occurrences. Option D. Delegating the primary responsibility for risk identification to junior staff members who are less experienced but have more time to review documentation. Correct answer is A. Implementing a scenario-based risk assessment methodology that explores hypothetical future events and their potential impact, alongside a continuous monitoring system for emerging threats. Explanation. This scenario presents a professional challenge because it requires a nuanced understanding of risk assessment beyond simple identification. The firm must not only recognize potential risks, but also evaluate their likelihood and impact in a way that aligns with regulatory expectations and ethical obligations. The challenge lies in moving from a reactive identification of issues to a proactive, forward-looking assessment that informs strategic decision-making and resource allocation. Careful judgment is required to balance the need for thoroughness with the practical constraints of time and resources, ensuring that the assessment is both comprehensive and actionable. The correct approach represents best professional practice because it directly addresses the core principles of risk assessment as mandated by regulatory frameworks. It involves a systematic process of identifying, analyzing, and evaluating risks, which is fundamental to maintaining financial stability and client trust. This approach ensures that potential threats are understood in terms of their probability and potential consequences, allowing for the development of appropriate mitigation strategies. This proactive stance is crucial for compliance with regulations that emphasize robust risk management systems, thereby safeguarding the firm's reputation and its clients' interests. An incorrect approach that focuses solely on historical data without considering emerging trends would be professionally unacceptable. This fails to meet regulatory expectations for forward-looking risk assessment and could lead to a false sense of security. It represents an ethical failure by not adequately protecting clients in the firm from future, unquantified risks. Another incorrect approach, which prioritizes the identification of risks with the highest potential financial impact while neglecting those with lower but more probable impacts, would also be deficient. This selective focus can lead to a skewed understanding of the overall risk landscape, potentially leaving the firm vulnerable to a cascade of smaller, yet cumulatively significant, issues. This demonstrates a failure to adhere to the principle of comprehensive risk evaluation, which is a cornerstone of regulatory compliance and ethical conduct. Professionals should employ a decision-making framework that begins with a clear understanding of the firm's risk appetite and strategic objectives. This framework should then guide the selection of appropriate risk assessment methodologies, ensuring they are tailored to the specific business activities and regulatory environment. Regular review and updating of risk assessments are essential, incorporating new information and changing market conditions. This iterative process, grounded in a commitment to regulatory adherence and ethical responsibility, allows for continuous improvement in risk management capabilities. Question 20. Upon reviewing a client's portfolio and their stated desire to significantly increase exposure to a highly speculative asset class, which approach best aligns with professional conduct and regulatory expectations? Option A. Agree to the client's request but subtly adjust the allocation to a less speculative asset without informing the client. Option B. Immediately execute the client's instructions to increase exposure to the speculative asset class, as client instructions are paramount. Option C. Discuss the potential risks and regulatory considerations of such a move with the client, explaining why it may not be in their best long-term interest, and propose alternative strategies that align with their risk tolerance and financial goals. Option D. Inform the client that their request is ill-advised and refuse to implement it without further explanation. The correct answer is C. Discuss the potential risks and regulatory considerations of such a move with the client, explaining why it may not be in their best long-term interest, and propose alternative strategies that align with their risk tolerance and financial goals. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between a client's explicit instructions and the advisor's fiduciary duty to act in the client's best interest, particularly when those instructions might lead to suboptimal outcomes or regulatory breaches. The advisor must navigate the delicate balance of client autonomy and professional responsibility, requiring careful judgment to avoid both client dissatisfaction and regulatory censure. Correct approach analysis. The correct approach demonstrates best professional practice by prioritizing the client's long-term financial well-being and adherence to regulatory requirements. It involves a proactive and transparent communication strategy. The advisor should clearly explain the potential downsides of the client's requested strategy, referencing relevant regulatory guidelines, e.g., suitability rules, principles of good conduct, that mandate acting in the client's best interest. This approach upholds the fiduciary duty, fosters trust, and educates the client, empowering them to make informed decisions aligned with their objectives and regulatory expectations. It is ethically sound and professionally responsible. Incorrect approaches analysis. One incorrect approach involves immediately executing the client's instructions without further discussion. This fails to uphold the fiduciary duty to act in the client's best interest and could lead to significant financial detriment for the client. It also risks a breach of regulatory obligations concerning suitability and client care. Ethically, it prioritizes expediency over client welfare. Another incorrect approach is to dismiss the client's request outright, without providing a reasoned explanation or alternative. This demonstrates a lack of client engagement and respect for their autonomy, potentially damaging the professional relationship. It also fails to fulfill the advisor's responsibility to guide the client towards appropriate financial strategies, potentially leading to a breach of conduct rules that require clear communication and justification of advice. A third incorrect approach is to agree to the client's request but subtly implement a different strategy without full disclosure. This is a serious ethical and regulatory failure, constituting dishonesty and a breach of trust. It undermines the principles of transparency and client consent, and could lead to severe disciplinary action. Professional reasoning. Professionals should adopt a framework that begins with understanding the client's stated objectives. This is followed by an assessment of the feasibility and appropriateness of those objectives in light of regulatory requirements and the advisor's professional judgment. If a discrepancy exists, the professional must engage in open and honest dialogue with the client, explaining the rationale behind their concerns and proposing alternative, compliant, and beneficial strategies. The ultimate decision should be a collaborative one, informed by expert advice and a clear understanding of the risks and rewards involved, always prioritizing the client's best interest and regulatory compliance.